Hello, everyone, and welcome back to the BP Learning Channel. Today, we are here to talk about how to measure and monitor your business performance. This is part 3 of a 3-part series called Getting Your Books Up and Running. Our focus will be on good financial reporting and periodic reviews of business performance. 2 important ingredients for business viability. In earlier sessions, we talked about diligent planning, success ingredient 1. We learned how to write a business plan and quantify that plan with measurable goals. Today, we will put all 3 of these success ingredients together. I'm Debbie, a certified SBDC coach at the Business Incubator Center, a partner with the Colorado Small Business Development Center under the SBA. I am also a former business owner myself, a former CFO for multiple startups in the Silicon Valley, and a CPA with a master's in finance. Today, I want to take another look with you at business viability. Success over the long haul. The Viability Train. It's all about 3 major ingredients. Number 1, we plan. Diligent planning. Number 2, we measure performance with good financial reporting. And number 3, we monitor success using periodic reviews and assessments. These ingredients drive the viability engine, and this is the kind of train you want driving your business. Every business should have a dynamic system like this one. Yes, you have seen this train before, but now that you have a good financial reporting system in place, let's learn how to get this train rolling. We'll start with diligent business planning. Success ingredient 1, making your vision come true. What do you need? A comprehensive plan, updated once a year. An annual budget. Ongoing monitoring, which includes industry and economic conditions, regulatory impacts, and business performance, and updates of your business plan and budget if conditions change significantly. Bottom line, you need a comprehensive plan, one you can monitor on a regular basis, at least monthly, and you might need a budget. Let's talk about budgets and why you might need one, even though you already have projections. Budgets versus projections. Both quantify success of a business going forward. So, what's the difference? Budgets are fairly static monthly cost estimates prepared once a year used to set spending limits. In larger companies, this is often done at a department manager level. Projections, on the other hand, are a more real-time tool for a 3 to 5 year period that gets updated on a rolling basis. Most companies prepare projections once a year and update them quarterly. Budgets control costs at a micro level in great detail by department, location, project, product, service. They are used to measure management performance, often a bonus trigger at the end of the year, evaluate customer projects or job performance, evaluate product and service line performance, plan for capital expenditures, minimize fraud opportunities, identify negative trends, and plan for business fluctuations. Let's take a peek at a budget variance report now so you can see what I mean. We are looking at a budget report with monthly variances related to gross profit for Rock Castle Construction. The first column presents the actual results of the company for November. The second column is the budget, and the last two columns present the variances in dollars and percentages. Yes, QuickBooks does have a nice budgeting system that allows you to take a deep dive into possible cash flow issues. In this case, gross profit exceeds the budget. That's a good thing. But there is an overage in subcontractor labor offset by additional construction income. Now, we looked at this for gross profit, but this kind of analysis should be done for every account with significant variances. And now, let's talk about how projection updates work, using projections for Jake's Family Sports Bar and Grill. As you may recall, the projections for Jake's were done in a 5-year spreadsheet model, and the first 2 years in this model were month by month. So, as the months roll by for year 1, and after the books are closed for each month, we replace projected numbers with actual results. Then, we do a variance analysis. We study the variances carefully. In this case, revenue declined 26.2%, or $75,000, with most of this decline in alcohol sales, 33%. A closer look into this situation indicated that prices went up, so customers purchased less, and there were fewer customers than projected. So, the remaining year projected numbers should be revised, and that's what we did. We brought these numbers down a bit. You can see this in the forecast columns. Now, we did this for revenue, but the same kind of work needs to be done for any other significant variances. And now, let's talk about success ingredient 2, good financial reporting. Reports that help you answer the questions, am I making money? Can I grow? How do I measure performance? A good reporting system will have accounting and operational integrity, include projection updates by month, by quarter, by year, generate budget variances at least monthly, include weekly and or daily cash flow reports, and produce meaningful financial and operational reports. That is why we spent so much time selecting the right finance system and working on your chart of accounts. A good reporting system will help you measure business performance every single day. What are your books anyway? And what does it mean to close your books? Well, it's a 3-step process, a combination of measuring and monitoring performance. The measuring part is usually done by finance keepers, those bookkeepers and accountants. It's the first 2 steps of the process. Step 1 is reconcile. Reconcile accounts, that is, bank accounts, credit card accounts, loans at a bank, at the SBA, or other similar accounts. Step 2 is to analyze accounts. Accounts receivable, accounts payable, inventory, trends, sales, and expense accounts. The significant ones, of course, and that's the measuring part. Reconcile and analyze. Step 3 belongs to management. It's a review process that includes the balance sheet, the income statement, budget variance reports, projection variance reports, benchmarking related to the industry and competitors. And finally, based on all of this great information, plans may need to be altered. This is what your management team should be doing. That's a lot, but it needs to be done. And now, let's look at what the closing cycle is. Every company should close its books monthly using a checklist. Basically, a list of accounts to reconcile and analyze every month. A monthly closing template can be found at a link below this video. A company should close its books within 5 to 10 business days after month end using a checklist and standard reconciliation and analytical procedures. Once this is done, financial reports should be distributed to management for review. If revisions to the business plans are required, management should develop and implement changes. Okay, these periodic reviews are ingredient 3 to success. It's all about making adjustments along the way, not only in the plan itself, but in your daily business operations. You might have to make significant changes like finding a new location, larger or smaller, eliminating or adding a product or service line, expanding or contracting staff, investing in expensive new equipment, refinancing debt or getting new debt, bringing in new partners, one or more of them, buying out a partner, and a whole lot more. I could go on and on about why you have to measure and monitor results, why these periodic reviews are so important. But let me just say, it's all about viability. Maximizing performance over the long haul. Let's go over your homework assignment now. It's all about how to set up your very own system to measure and monitor performance. To be able to answer the question, what do I need to know to be successful? I want you to, number 1, using your chart of accounts and the free template provided under this video, prepare a monthly closing checklist for your business. 2, prepare a list of reports you would like to have for your monthly management review. And 3, prepare a list of key performance indicators you will use to monitor your business. Yes, there's a whole lot more to do to get a system like this in place, but this will help you get started. We're almost done now, but before you go, I want you to spend some time thinking long and hard about what the mission of your business really is. Your overall plan, your compensation requirements, and your exit strategy. Your mission drives performance. It drives profitability and value. At the end of the day, it's all about how much money you want to make, and that depends upon what kind of business owner you want to be. Most folks who come to see me are Type 1 business owners, tax-minded leaders. Their overall plan is a sustainable business. They want to make a decent living in terms of compensation, and the exit strategy is to pass the business on to a family member or wind it down. The predominant goal is to minimize taxes and survive. Other folks who come to see me want more, but their zest for wealth is moderated by the effort and risk involved in making it happen. I call these folks borderline entrepreneurs. Their overall plan is to scale the business successfully. In terms of compensation, they want to make more than they could make working for somebody else. And their exit strategy is a possible sale with a generous payoff. Their primary goal is to be profitable and grow. Now, some folks who come to see me are what I call Type 3 business owners, entrepreneurs at heart. Their overall plan is to grow exponentially, earn executive-level compensation, and exit the business via a sale or public offering. They want to get rich. Their primary goal is to maximize performance and grow. So, what does this mean for you? It means you get to weigh the cost and choose what kind of owner you want to be. That said, VDOP is for every business owner, but we will push you to be Type 2 or Type 3 owners. Why? Because we understand the risk involved in being a business owner, and risk should translate into reward. So, bottom line, we believe you should make more money. We will push you to chase after more money. But remember, you get to choose. We will support you in whatever you want to do. It's your risk, it's your business, and it's your money. And that's the end of part 3, getting your books up and running, how to measure, monitor, and grow your business. It's all about maximizing business performance, profitability, and value. So, for now, subscribe to the Butterfly Paws channel below and get started on your homework assignment. And I'll see you the next time.